The United States and China are pulling back from the brink of a trade war after the world's two biggest economies reported progress in talks aimed at bringing down America's massive trade deficit with Beijing. According to the U.S. Treasury Secretary Steven Mnuchin, the two countries had made meaningful progress and that the administration has agreed to put on hold proposed tariffs on up to $150 billion in Chinese products. China had promised to retaliate in a move that threatened a tit-for-tat trade war. And joining me now to look at the possible impact of this on Nigeria and other burning economic issues is one of the research analysts with financial derivatives company, Damilare Adeshola. Hello, Damilare. Good to see you. Good morning.
To see you too.
So how welcoming is this news that U.S. and China have agreed to cease fire on the trade war?
Definitely.
First, for the global economy.
Yes, okay. Well, so definitely it's good news. Let me just start there. But then also I think primarily, so we expect to see in the global scale, we expect to see a rally in equities markets. Initially, when the first announcement from Donald Trump came on the ban and then China retaliated, we saw a dip in equities markets all around from the Dow Jones to the Japanese stock market. So we expect to see a rally in the aftermath of this, but also in the commodities market as well. We expect to see, because before it was good for oil prices, for example, but now, since we expect that increase in Chinese demand, because that was a threat that the trade war was posing, so since we expect to see an increase in Chinese demand, that might have a not so good effect on oil prices. But I think oil prices have other things that are driving it at the moment, so that may not be too bad. If you notice in the aftermath, because the whole conversation, as you said, with the Treasury Secretary went on last week in Washington, and in the aftermath, we saw oil prices decline to about $78 per barrel from after hitting 80, but now they've increased as at this morning to about 78.5. So there are other driving factors in the oil market. So that's primarily on the global front. But and looking at Nigeria, I think definitely, you know, there's a saying that when two elephants are fighting, it's the grass that suffers. So I think, although there are talks and there are views that maybe Nigeria can step in providing maybe agricultural products or oil or energy products, I think that it's in our best interest that these two superpowers are on good terms. Because although,
why?
Because so it's not an either or. So it's not like China. It's not a China or U.S. Scenario. Both of them would be good. Even for our look at foreign policy, we see that China makes up about 20% of our imports, but U.S. on the other hand, although it makes up about 8% of our imports, we send about 10% of our exports to them. So both of them play, and also U.S. with security and intelligence providing support there. So both of them play a good role, and so you don't want to get on bad terms with any one of them. So it's good for both of them.
So in other words, if U.S. would have to slam a tariff on China, perhaps the Chinese government will probably pass it on to our importers or people who import from them.
No, well, so looking at the other way around. So if China slams, because we have more exporting similar with U.S. than with China. China specializes more in manufacturing and machinery, which we're not experts in. But looking at U.S., which has energy products and agricultural products. So if China was to slam a tariff on this, and that then decreased their imports of those U.S. products, if thinking that Nigeria could step in. But then if Nigeria then steps in, that might have a negative impact on our relations with the U.S. So it's good to just sort of step back and just not get involved.
Okay, I know that they have chosen to cease fire. What impact will that have on Nigeria and, of course, the domestic commodity?
I think, so primarily as the domestic commodities, we'll see with oil prices, we'll see oil prices may sort of soften the bullish one, so it's one less reason for oil prices to continue to rally on. But then also looking at other prices like wheat and corn, we saw an increase in these prices because then it then increased the chances of because looking at the Chinese demand, so China would now continue to import grains, so that's wheat and corn from the U.S., and so that was good for prices, and so that boosted prices. But then we import these products, and so then that would have a negative impact on our domestic commodities because it could imply an increase in flour or corn and maize. So that's, and even most of some of the importers or manufacturers of flour even actually planning for an increase, a hike in prices.
Yes, we'll talk about that.
Yes. so that's generally the expectation for the domestic commodities.
Okay, so what steps do you think the federal government probably would need to take now to hedge, against such external risk factors? I mean, yeah, U.S. and China fighting, and then Nigeria, we are like, oh, please, what's going to happen?
I think it's just focusing on our bilateral trade with each of them. So as in we did the whole yuan and naira swap deal, which I think is mostly good for diplomatic reasons as opposed to economic reasons. The economic implications are weak and meager, if anything. But then I think the diplomatic implications are pretty strong. So just building on that, and with Buhari visiting the U.S. and all of that being the first sub-Saharan president. So just building on our bilateral relations with each of these countries separately, and so that in the case if they do butt heads, we don't get involved because we have good relationship with both of them.
What about improving on our economic diversification strategies?
Okay. I think so. It'll be good if we get if we have, so with the swap deal, for example, people are saying that it's positive because it then means that people can import and export cheaper and all of that kind of stuff. I don't want to get into that. I have opposing opinion about that. But then apart from that, I think it's a good strategy because both of them, as I mentioned earlier, are leading markets for both our supplies and both our exports. So leading markets for our imports and our exports. So it'll definitely be good for that.
All right, one other burning economic issue is the first quarter GDP, which came in quite disappointing at 1.95%. Now, for you guys at FDC, how disappointed were you when you saw that? Were you expecting such number?
I think actually, to be honest, so first of all, usually this is the trend. Usually Q1 is usually softer than Q4. But then we actually were predicting...
Why would that be so?
Because there's a decline in economic activity. So we go from the peak in Christmas time. There's more manufacturing. There's traders are buying more, stocking up inventories. PMI is doing great. So usually you move from that high, and then people are sort of recovering from their from all the spending. So you usually see a decline in private consumption as well as a decline in inventory stocking. So that's the trend. But then we were actually expecting the number to be lower than it was. We were expecting initially we were expecting it to be that high, but then when we started to look at what was going on as we're moving into the quarter, we're like, okay, it may not be as high as we initially forecast projected at the end of 2017, when we started to look at the PMI was performing poorly. We're looking at just a lot of different variables, and so it was actually stronger than we expected it to be. But then I think that it's still in line with our general full year forecast for the year. We're expecting something in around 2%, 2.2% if we're lucky.